This is Paul. Thank you very much for attending today's webinar. And what I am going to do here today is spend approximately the next hour through a very unique options strategy I think you will find quite interesting. And one of the things I wanted to mention right at the outset is, for those of you that may have questions as I'm going through the presentation, feel free to type whatever questions or comments you have in the chat window, and periodically view what you've got in there and either respond to the answers or respond to the questions with answers right away, or perhaps it will be something I can cover there in the presentation. Also, as a preliminary announcement, if any of you happen to be attend Traders Expo in Las Vegas this week, tell us, feel free to stop by the Option View booth and say hello. I will be there along with some other folks from Option View. Okay, so what we're going to talk about here today is vertical swap spread. And really, you know, all of us as options traders have an enormous variety of option spreads to choose from. Some earn positive time decay, some have negative time decay, some are directional, others are neutral, some benefit from a rise in implied volatility, and some benefit from a decline in implied volatility. What type of an option spread you do really comes down to how you really want to allocate your risk between market movement and change in implied volatility. Willing to put on a spread that positive time decay, or if you're willing to put a spread on that actually incurs negative time decay. So I'll show you today, I consider to be a pretty unique strategy that can be used in certain futures and commodity markets, and a way to trade in what's considered to be a very risk-averse, low-margin fashion. And if I'm talking in terms of the Greek variables that I'm sure most of you are aware of, it's a technique with low delta, low gamma, positive beta, and low vega. So what I'll do now is share my screen, actually my desktop, and let's see here. You should be looking at my quotes display on Option View. Now let me be sure that you are in fact seeing that. Okay, excellent. All right. Well, now what I've got here is a complete listing, complete anyway, of the various commodity markets, starting with the Australian dollar at the top and all the way down to wheat on the bottom. What I'm with is by pulling up a matrix for the gold markets. I don't know how many of you are commodity traders, but a gold futures contract that is based upon 100 ounces of gold, and the current price of gold is approximately $1,730 an ounce. We're talking about buying contract value of close to $173,000. Needless to say, this is a contract size that is much larger than a typical equity option market, because equity options are dealing 100 shares of stock, and if a typical stock is in the neighborhood of, say, $70 or $80 a share, you're talking about an $8,000 contract. Here we're talking about, as I say, $173,000. The strategy I'm going to show you works with large contracts of this size. So here's an example. The swap strategy is a that is designed to earn positive time decay. So how to earn positive time decay? You have to sell options or sell option spreads. So look at constructing a position that is bullish in gold as a starting point. Bullish in gold. Well, what we're going to do, we're going to look not at December options that expire in 16 days, but we're going to start by looking at the January options that expire in 45 calendar days. And the January options in gold are tied to the February futures contract. To a close to the money put, and at the money put in January, I'll be selling the 730 put. That's going to get plenty of positive time decay. I'll go ahead and make this into a vertical bull put spread. What means I'm going to have this 1730 put by purchasing an out money put also in the month of January. And I'll go with the 1675 put and push that. As you see, I've got my matrix formatted in such a way that we can see the price in the first field, the delta of the option, the open interest of the option. Then I have an existing position and a trade field as well. So constructing this 1675, 730 bull put spread, that spread by itself is very familiar with, and a graphic analysis is pretty much the Analyze button in Option View, hold up the graphic analysis, so it's red and easier to see. If I change the size of what's on the screen, we can get the current futures price line up with this green vertical line that you see. So this is a typical looking performance graph for a bull put spread. I've got 4 what are called performance lines displayed, so that depending on what date we want to project to, we can see how much money the spread will earn on the upside or how much the spread will lose if the market declines. This is part of what we're going to be doing with our vertical swap trade, because now if we say to ourselves, this position is vulnerable on the downside, how can we possibly hit ourselves against the downside risk? What we do is we can go out to a deferred month, whether it be February or March, and I'm going to choose March, and we're going on the exact opposite position. I'm going to purchase the 1630 put in March, and I'm going to sell the 1675 put in March. That is a debit or a bear put spread, March puts. Analysis on that, look exactly the opposite of what we were just looking at. There was a bull put spread. However, when you all 4 pieces together and how these 4 different options can work together as a spread position, take a look at Greek variables underneath the matrix. Delta is plus 9.37. That's 9 deltas positive. It's a bullish. It's very small, minus 0.12. Gamma tells you how quickly deltas will become unbalanced as the market moves. So gamma is a good thing when you're in a position of this sort. Theta, positive time decay, is a little bit more than $4 a day starting out. And omega, the sensitivity of this position to changes in implied volatility is minus 14. That's $14 of sensitivity. $14 of profit implied volatility declined by 1 percentage point. Of loss, if volatility rises. Back to that in a moment. But now click the Analyze button for this forward position. Here's what we're looking at. change the scaling a little bit here. Make it a $20 increment on the x-axis. Now, what we have here, we have a position that clearly in the short run, if gold rallies, this positions money right away. You look at the performance curve, there's 9 here, which is T plus 15, or if you look at the T plus 30 line, T plus 30 would be 1 today. Now you can see how the profits on this position build at an unchanged or at a higher level, because it started with a 9 delta positive trade, and 30 days have gone by. We have a trade at an unchanged level with 18 positive deltas. It'll be positive until we get up to the 1770 level, where the deltas become neutral, and rally above that, the deltas start to be negative. Start to our peak profits of $100 in 30 days start to dissipate if the market continues higher. This is how this trade also performs on the downside. Really, the downside is going to lead to losses, because starting off with a modestly delta long position, and the deltas become slightly longer as the market declines in price. Here with this trade strategy is a bull put spread in the front month of January is that we want to hedge for the downside risk, and that's why we do the March bear put spread. The combination of these two positions gives us a position with very active potential profits on the upside and modest losses on the downside. Profits, and let's say that we had just a modest move up in 30 days and we earned $650 of profit. That profit is something that you want to look at in relation to the margin of the trade. The margin of this trade is $1,400. So the return on margin would be in the neighborhood of 45% return in essentially a 1-month period of time. Needless to say, that's quite attractive. The beauty of this trade is it does give you the potential to earn a very high return on margin. You happen to be correct about market direction. The other big benefit here is that the sensitivity of this trade to changes in implied volatility is very small. Note, even after 30 days, the predicted vega on this trade at a price of $17.50 on gold is minus 18.63. So if volatility were to go up by 4 percentage points as gold rallies, we go forward here, and that would mean that our profits will not be $630 but $540. We don't need to be real good at forecasting implied volatility, because whether it goes up or down, it's not going to have a big impact on our position. We'll pull up to show a graph of not only implied volatility but gold prices. So what we're looking at here, we're looking at a historical bar chart of gold prices. At the bottom, we have the blue line, which is implied volatility. You can see that implied volatility sort of follows its own pattern. It marches to its own drummer, its own drummer as compared to movement in gold. You can't see that when gold rallies, implied volatility goes up. When gold declines, implied volatility goes down. It's not a very, very good relationship there. So you don't want to be vulnerable to incorrectly forecasting implied volatility. As a matter of fact, that's the beauty of this trade structure. It sort of takes volatility out of the profit and loss picture to a great degree. If implied volatility were to decline, say, by 4 percentage points, that helps the trade because we have negative vega factor. But we're really banking on the passive time decay with a very minor directional bias. Now, I'll pause for a moment. I know there have been several questions that were up here, so let's see what we've got. What is an optimal look-back period to look for high volatility and volatility percentiles? Well, I'm not sure that there is such a thing as an optimal look-back period. The optimal look-back period, if anything, would be the period that coincides with the anticipated trade horizon for how long you plan on being in the market. In this case, we're not even worried about the absolute level of implied volatility or how it's going to move up or down. We're looking more at the time decay and delta and the old shape of the curves. Another question here, why refer to this position as a vertical swap as opposed to a calendar swap? Well, a good question. You can call it either one you wish. It is vertical put in January with an opposite vertical put spread in March. But if you look back at the matrix, you also look at trade as a calendar spread between the 1730 put strikes, the calendar spread, along with a reverse calendar spread using the out of the money 1675 puts. A calendar spread is when you sell the front month and buy the deferred month. Or calendar spread is when you buy the front month and sell the deferred month. You could call this a calendar swap as opposed to a vertical swap, if you wish, goes by either name. This presentation is being recorded and it's available for viewing on the Option View Facebook page. And it'll probably be available for viewing either later today or tomorrow. It will be posted there. How is this different than a regular calendar spread except using spreads instead of outrights? Well, it's a regular calendar spread at the money in combination with a reverse out of the money calendar spread. We've got a swap going here, a calendar swap. You did not compute the 4 commissions in your P&L graph, I suppose. No, I did not, because everybody pays different commissions. On traders pay very low commissions. Traders with a full-service broker pay higher commissions. I want to show you how this trade can perform without doing it with an assumption on commissions. See, Jim Graham has put up the option link to Facebook where you will be able to see this presentation, as well as other presentations that have been done in the past by other Option View mentors. Be available usually within the hour after we finish. It's pretty quick. Another question, do you leg into these positions? That's one thing you want to avoid at all costs. Leg into positions leaves you vulnerable to incurring loss if you happen to get filled on one leg, and before you can get filled on the other leg, the market moves unfavorably against you. Personally, put these as one four-legged spread and limit price and get filled on that usually very easily with maybe 1 or 2 modifications to the limit price. That's how you do it. Now, this would be the way to construct a bullish oriented position. I'm going to erase these here. I'm going to show you what if you had a bearish outlook on gold. Well, then you work with the call options. You go to the at-the-money call, the 1730 call in January, sell, and delta of about 52. Look down this option lane, and I'm going to find a delta, the 1800 call, which is delta of 21. I'm going to do a bear call spread with a delta, according to the screen here, of minus 31. Then I'm out to the month of March, and I'm going to do exactly the opposite. Where I'm below the 1800 call in March, I'm going to buy the 730 call. So now I have my four-legged spread in place, and here's trade looks like. And those colors on the screen. So now I've got about a 10 or 11 delta negative position starting out. $6.50 of positive theta, time decay starting out. And it's a little bit more negative in this case, minus 29 starting out. as compared to the spread we looked at. But if I click on the T plus 30 line, now you can see how the profits start to build on this trade at an unchanged level or at a very wide range on the downside. After a month's time, this trade exactly break even at 1750.8, even if the market were to move up a little bit. Losses become much more substantial, however, if the market rallies up to 1770. So obviously, this trade is not a trade that is bulletproof. No trade really is. There are ways that you can lose, and the real way you lose on a trade of this sort is the market moves to a large degree in an unfavorable direction and don't really or modify the position as you sit with it. So if you'd sit with this trade for 30 and you let the market run all the way up to, say, the 70-90 level, well, then you're going to have an $1,100 loss. But there's reason to let it happen. If it's up enormously in one day, the loss would be smaller. It would still be a loss. Now, the interesting thing about this trade, there are ways that you can modify or adjust it in the event the market does move unfavorably. But the market did start to rally, and you used your view, and the market went up to 1750. In the very day, it was a $20 rally. And perhaps it was some news that caused gold to jump. And well, you know what? I really don't want a bearish position. I want a bullish position. Well, you can easily do what we call flip this trade around. Flip it around. Get your delta from being minus or negative, in this case minus 1279, being positive. And the way of doing it is to go back to the matrix, prices that you've got here, and realize that all you really want to do is look at your reverse calendar spread, use out of the money options to replace that calendar spread, reverse calendar spread, with a reverse calendar spread using out of the money puts. So we're going to close our 1800 call reverse calendar spread, and we're going to open an out of the calendar spread using puts. So we'll go to, let's say, the 1650 puts, and we'll buy one of those in the month of January and one in the month of March. Let's see what it looks like now. And we have changed the dynamic dramatically. We went from being 1279 deltas negative. Now we are 6.81 deltas positive. Basically changed our bias from bearish. And goes by, the trade can continue to earn increased amounts of positive time decay. And a Vega factor, interesting enough, when you click on these different timelines, you can Vega factor, even though it is minus 23 at the 1750 level right now, 15 days it becomes minus 20, and in 30 days it becomes minus 4. So our Vega sensitivity becomes less and less. Higher levels, assuming gold continues to move up, the Vega sensitivity becomes increasingly positive. So it does start to become more sensitive to implied volatility as the market moves more. This is an interesting way of maintaining a four-legged position by simply closing the reverse calendar spread that we have and replacing it with a reverse calendar spread of the opposite type. We close the calls and we open up puts. How did the flip adjustment cost? Well, if we would have done this flip adjustment today, if this was a one-day event, what would happen is, if I go back to the position that we had, and it were to rally up to 1750, where a flip adjustment, right now, that means the market will have rallied by approximately $20. So 1,800 call we had in January, which was 1170, That's going to be priced at probably about 1610 because that's where the 1780 call is. So you're buying that 1800 or selling that 1800 call for a profit in the neighborhood of about $5. Then 1800 call in March that we sold, that we buy back. We're going to be that back at a price of approximately $38.80. So that's going to be $6.20 higher in price. So we're going to loss by closing out the 1800 reverse calendar call spread. It's because the market was moving unfavorably. When we put this trend at the 1650 level, as you're looking at here, are for where gold is right now at 1731. If it's $20 higher, we're going to be spending less money. We're going to be spending $8 on this. We're going to be selling it for about $580. We'll be selling this 1650 March put for about $19.70. So that's what the prices would probably be. I've got real-time quotes in gold right now, but this is the aftermarket trade in gold where it's being traded electronically. But nevertheless, as long as you can get reasonable prices on the spread based upon theoretical value, that's the type of an adjustment that you would want to make. Let's see here. How to use these spreads if you have a neutral view of the market. That's a topic that I will get into perhaps a little bit later in the discussion today. But essentially, the short-term answer is we looked at a vertical call swap, then we looked at a vertical bull swap. If you would put both of them on at the time, you'd have an 8-legged position, and that would be delta neutral. Question, can you reverse your swap the same way? You can. If we had a bullish swap, which is essentially we were looking at before, where we're 1730 put, we're long, an out-of-the-money put, opposite position March. Now we have a bullish position, and if we want to flip it around to become bearish, we do the very same technique. Here, out of the money, 1675 reverse calendar spread. We close it, and we replace it with a reverse calendar spread using out of the money calls. Choose whatever strike happens to give you the net delta you like. If I just choose at a quick glance here, the 1775 calls, now we've around to be modestly bearish, but we make it increasingly bearish by going further out of the money. The 1800 call, for example, that would be a lot more bearish. Let's see, is that right? You did. Delta's bearish. Maybe not bearish as you would like, but the quick and dirty way of changing the position from bull to bearish. There is another way where you start off with a position that is increasingly bullish. So instead of using the same strikes in the deferred month of March, if you use a narrower set of strikes in the month of March, in other words, the insurance that we are buying in the month of March is going to be less costly because it's a narrower spread, now going to be more biased where delta is starting out, 17 deltas long, as opposed to what we had before when we used the very same strikes. We were about 9 deltas long, not 17 deltas long. But remember, delta is a percentage number that tells you to what degree you are operating in movement in the futures market. A 7 delta long position is going to be great if the market's gone up in your favor, but you're going to be very happy if you happen to get in with 7 long deltas and the market starts to drop. Then you're going to have some losses to a greater dollar loss immediately as compared to a smaller delta position. These positions are not in the sense that they're flexible and they give you the ability to acquire whatever delta you wish. And of course, the larger the delta, the more risk you're taking. The thing is, you'll find working with January and March options. in March, I separated the option durations 2 months. Now, is magic to that? No. We could have used January options in relation to February options. Essentially, the same sort of position. It's going to be slightly different in slope on the performance curves, and also going to be slightly less positive time decay. The positive time decay is going to be greater the more you separate your vertical credit spread from your vertical spread. So you have some issues here to choose from. This is where option view comes in really handy. You can experiment with different combinations of months. You can experiment with how wide you want to make the difference in the strikes. And you want to use the very same strikes in a deferred month, whether you want to shorten them up, as I was you before. In other words, buy less insurance, and it will make your deltas more positive, and it will even increase your theta. But when you start changing the width of your insurance in the deferred month, you're going to find that your factor is going to be greater. You're going to find your margin is going to be greater because it is a more risky position. Let's see. One question here. The 8-legged market neutral spread you described would be with box spreads and embedded calendars, would it not? Well, I get into all kinds of terminology that a lot of people may not be familiar with, but let's go ahead and show you what this legged spread would look like. Here we have our bull vertical. Now do a vertical bear call spread. We're going to go at the money call again, or the strike again with calls. We're going to sell that. We're going to buy that one. And we have a separation in the strikes of 55 points. So if I go 55 points above the 1730, that would bring us to like the 17 8 strike form in the width of what we're working with. So now we got all 8 legs in place. It is a delta neutral position with positive time decay. It's going to have a vega factor that starts off at minus 36. As time goes on, you can see it does become a little bit more negative. Short run, as the market moves, the vega factor becomes smaller in magnitude on each side. This would be a neutral position, all 8 legs. I honestly am not that fond of using this strategy to create neutral positions. I'd rather create a very modestly directional trade, bullish or bearish, based on what I expect the market will do. And then if it starts to go my way, that's great. Because we start off with a neutral position like this, it's only a matter of time before if the market drops down to this level, say 1690, and you're 6 deltas long and you're losing a little bit of money, or gets up here to 1770, then you may want to make an adjustment. So vulnerable in both directions with the neutral position. For this concept of adjusting, I show you the flip adjust to go from long to short or short to long, but you could, with either this neutral position starting out or with the directional position starting out, you could right ahead and adjust with a vertical spread. Adjust with a vertical spread. So with looking at the neutral position, I'll give you an example. If the market runs up to 1770, we become delta short, and we don't want to let the market continue to go up and have us be in the zone of vulnerability. What we can do is say to ourselves, what do we do in the way of modification to get delta from being minus 6 to being to 0 again? We'll do a vertical or a bull put spread adjustment. Go back to the matrix. Vertical put spread collects a credit. We're going to be selling put and want to sell a long put that we have, just things simple, sell this put and not buy the 1650 put to replace it. That would be a bullish vertical put spread. So if we take a look at our graph, at this level now, 1770, we're basically close neutral. We're only 1.7 delta short instead of what we were before, which was 6 delta short. We've kind of eliminated in the short run vulnerability if the market continues to move higher. So we've shaped these curves where they're now kind of more horizontal on the right side instead of sloping down on the downside. First, of course, going the other way. You just want to do a vertical bull put spread. If the market is moving higher, you do a vertical call spread. If the market is moving lower, you move in the direction, you adjust in the direction that the market is moving to eliminate some of your delta risk. I spent quite a bit of time on gold. I wanted to move to another asset. Basically, if you want to just note, of all the commodity markets, I'll tell you the best ones to work with, best and largest in underlying size. And what's important is, since we're structuring these trades as a credit spread in the front month and insurance or a debit spread in the deferred month, obviously we need to have option prices that are high enough so that the positive time decay that we are attempting to earn is going to be adequate. So that's why we need large underlying contract size markets. And to the extent that the market has high implied volatility, that's going to make the option prices high, and that can bend the position as well starting out. So markets that it's best suited for. Crude is one of them because crude is priced at $86 a barrel, and we've got 1,000 barrels is the underlying contract. So, 86,000 in under contract size. Gold, that's 173,000. Silver, good markets, because what we're dealing with in silver is a size that's about $32,000. However, when you add the price chart on silver and you look at the implied volatility, a nice implied volatility of 23%. So it worked well in the silver market. All honestly, silver is a market that has volume and open interest on the options than gold. Gold is going to give you perhaps tighter bid and offers on your options as compared to silver, but it is still a viable market. Then we've got the euro currency market, a good one to work with. This is priced at it's priced at 127, and the point is $12.50. $158,000 size market. That's a great one to work with. Bonds, 30-year government bonds, $150,000 in size. It's a good one. Mini S&P is sort of marginal because it just doesn't have enough implied volatility in combination with the underlying contract size. The underlying contract size of 1377 is 68,000 in underlying size. That's getting to be a little bit too small, but it could work okay. This is another one that's a market, and lesser extent, wheat and corn. So that's a pretty long list of, there's also the Japanese yen. That's another one that's a good one to work with. So you've got anywhere from like 8 to maybe 11 or 12 markets to look at. That's kind of nice because you can narrow down your focus. You don't have to be searching literally hundreds, thousands of issues to look at, like if you're a stock trader. A question or a comment here. The margin considerations seem to imply that these strategies are most efficiently employed with either and or portfolio margining. That's correct. Span margining is what is used for determining the margins on this. Most brokerage firms will go with the span margins. And if you have a brokerage firm that requires more than the minimum span margin, well, you may want to change brokerage firms. ETFs is the question. Yes, you cannot use the same strategy on ETFs, but you still have that underlying contract size issue to deal with. Most ETFs are going to be pretty small in contract size, and the biggest disadvantage, however, is the margining on ETFs, just the margining on stock options, is much more prohibitive than span margining on futures and commodities. So if you do this with an ETF or with a high-priced stock like Apple or Google or something like that, you're going to find that the margins are going to be probably 2 or 3 times what they are as compared to the futures and commodity spreads that I'm showing you. So there'll be much higher margin requirements, and the potential profit is going to be more in dollars as well. So your potential return on margin with a swap using ETFs or like Apple or Google is going to be a whole lot less than if you work with the market I just mentioned. Let's run through some other examples here. Like let's pull up crude oil and look at this. We've got January, February, March. We've got, options for every single month. And if we're going to work, let's go with the 30-day options in January. Oil is priced at 86. We go with the at-the-money strike. We're always wanting to start off with selling the at-the-money strike because at-the-money option, whether it be a put or a call, is going to have the most time value. And that's really what we're looking for. We're looking for the greatest time value so we can get the greatest positive time decay. If we then make a credit call spread on crude oil by using the 90 strike, then if we go out to March and we do the opposite, we've got a position that is 9.89 delta short. The margin, look how low it is, $899. Positive time decay. Well, this is a good light here, because when I pull this one up, you'll notice the black dot is away from the T+0 line. Well, crude is closed right now, so let's take a look and see what prices of these options are. This of 309 is very close to the theoretical value. 90 call is a little bit below theoretical value, but not significantly. When I look at the March price, now this one is quite off. It's because the bid and the offer, look how wide that is. We're after market trading, so we're not getting reasonable prices. If we just put in here what would the typical price would be, it's going out a whole lot closer to what we're looking for. Now we get the black dot moving closer to the T+0 line. And I could change all of these options to be equal values since we're in the aftermarket period, and that would help move that black dot close to the T+0 line as well. Why pick the 90 strike? Is it on this delta or what? Well, I mean, that's the thing I was saying before. You just have to experiment. If you the month of January itself, this is a 3 negative delta spread, earns $6 a day in positive time decay. Not even be wide enough. It may be more advantageous to choose a wider streak so that we're going to be able to have positive time decay on the 4-legged spread. So here's $11 of positive time decay on the 4-legged spread here. But it's a matter of the strikes that will leave you with the margin that you're comfortable with, leave you with the potential return on margin you would like to see. Let me clear this out. I meant the euro currency was another market that could be traded. We've got December options of 26 days. January was 54. March was 117. Now, the good thing about this trade strategy is when you do your credit spread in a deferred month, like if we choose March, well, let's put it this way. If you chose January versus March on this currency, and we did it with calls, let that in. We're going to have, for example, the 127.5 call is going to be a sell, and delta of 50 down to the 130.5 and buy that one. So now I have a 30 delta negative with about 567 for theta. It's kind of small, so we'll go ahead and spread out to get more positive theta. So that's about almost $10 of theta. That looks better. Now if we march, we do the opposite. We put about $6 a day starting out. But small the margin is, $475. That's like a drop in the bucket. So we take a look at this graphic analysis. And if I widen it out a little bit, effect 6 days into the future. Let me just expand this a little here. You can see there's a $419 profit at an unchanged level. Profits on the downside are pretty good. Profits on the upside are the profits on the upside over time, not in the short run, but over time. The break-even turns out to be 128.82. Any profits in here, whether it be $300, $400, those are extremely high returns on margin because the margin is only $465. If you're the type of trader that says that looks great, but $400 isn't what I want to sit and look for 36 days, all you need to do is change the quantities. Do a 2-lot or a 3-lot or a 5-lot, and all these P&L numbers get multiplied by that. The key is a 1-lot. If the return on margin is good, then you can go ahead and do multiple lots. What is potential return, and in what time span of the strategy? Well, the one looking at, you can see the potential return at an unchanged level is about 9% in 36 days. In 8 days, with $163 profit, that percent of 465 is a return of 35% in 18 days. So each individual strategy for each market, depending on strikes you choose and depending on months you choose, will have its own unique potential return. Okay, so here's the point I wanted to make when I pulled up the euro currency. Working with January and March, what worked with December instead? Let's use December instead of January. And out the time frame. What happened? We widened the time frame, and now the margin went from $465 to $125, and those became minus 12. So a little bit more negative deltas, but projection in 17 days is just the same dollar amount that we were looking at before, just a dollar amount. But the margin is a little bit higher, so you can get close to 45% return in 17 days. That's a shorter period of time. It's a short period of time because we're dealing in December options that expire in 26 days. Now, the 26-day level, you think, well, that's a whole lot better than in 17 days. But you remember that you're taking a lot of risk in that last 9 days between T plus 17 line and 9 that the December options expire. With spread strategy, when you get very, very close to expiration, your gamma risk tends to increase. You can see as I go through these lines, the gamma gets increasingly negative. And the gamma gets increasingly negative, meaning the slope rate of change in your deltas is becoming greater. You're taking more and more risk because you're trying to make more and more positive time decay. And I'm a believer in closing trades of this sort, as well as other trades before expiration date. If you have a reasonable return on margin, a reasonable profit is a return on margin, halfway to expiration date, the trade off, put on a new position. You always want to be able to more safely earn positive time decay rather than roll the dice and hope for the best in the remaining, say, a week before options expire. See, a couple of things. But you have to make adjustments that lowers the potential return. Some of these trades do never need to be adjusted, but if you do need to make an adjustment, depending on the adjustment you do, if you do the swap or the flip adjustment that I mentioned earlier, chances are, yes, you're going to have a loss to start out with, and you need time to go by to make back that loss and to turn profitable. If you have the adjustment that you do is not a flip adjustment, but a vertical bull spread or a vertical call spread, barrel spread, then adding fuel to the tank is the way I like to put it. You're selling premium for a credit. You're selling premium for additional positive time decay. So whatever loss you may have incurred, you could move unfavorably to start with, you have a chance to compensate and make all that back on the original position along with your new adjustment. Well, to me, that if the market moves against you in the first few days, you're going to be immediately in a loss situation and having to make a decision as to how much loss to withstand. Absolutely. Absolutely, that is the case. Here, this position, if we're 11 delta short and the market moves against us, if 128.03 and you lose $200 right away, is that the time that you get nervous, or you want to get one adjustment up over here at the 120.5 level, where it loses $350? And you have a choice on what kind of an adjustment you make. Do you adjust back to neutral, or do you do a flip to get delta long? Those are decisions that you have to make in advance so that you have a trading plan that you know you're going to follow rather than just knowing what your plan is going to be as time goes on and as the market moves. So, including the loss at this level, $350 right away is a lot different than a $212 loss if it takes 9 days to get there, or 17 days to get there. It's almost a break even. So you do need to have your plan in place in advance. It's a very, very important thing. Okay, so let's close this one. Let's take a look at the E-mini S&P. I mentioned that it's a viable candidate, but it's going to be a little bit small of a contract. But next, let's take a look at, let's say, a bullish position in this market to the heck of it. We'll go to the 1375 put. You can see there's enormous open interest on these options, so you're going to be able to get nice tight markets in terms of bids and offers. If we see 1375 and we buy the 1300 put, we've only got $4.57 positive time decay in that spread. So let's even further out and make it 1275. It's about $7 of positive time decay. Let's go to the month of February and put on the exact position with the opposite buys and sells. Now a 10 delta long position, positive time decay of $6 a day, margin $856. It looks like. Let me just straighten this out a little bit. Change color. And see looking at here. There we go. And I'll do the number of lines. Now if we go 26 days into the year, essentially 3.5, almost 4 weeks, now you can see what the potential dollars of profit are. Not extremely exciting because the magnitude is pretty small, say $337, but that 37, once again, as a return on margin, is about 27%. That still is very good. So in $2,500 a margin, you could do a 2-lot and that profit to be $600 and say $74 of profit at this level. But the E-mini, because it is a small underlying contract size, it's not giving you the effective dollars and return on margin that we could find like with crude oil, with gold, with the currency, and some other markets. How change the color so quickly? Well, with option view, when you're at the graphic analysis, if you click the Analyze button, colors repeatedly. I just keep clicking the Analyze button, and it goes through the different colors. Starts blue, changes to red, changes to pink, change green, and then starts the whole sequence over again. So that's all you need to do. Just keep repeat clicking that Analyze button. And of course, you can click on the performance curve that you wish by pointing at it and clicking it, or by in the box on the lower right side of the screen, just click on T plus what a date you want, T plus 0, T plus 13, so on. And by this T plus 0, T plus 13, all of those notations can be changed to the actual dates if you wish. By way up in the left-hand corner, go to File, and at the very bottom, instead of Display T plus N, you click on Display Dates, and then click OK. And if you do everything and reopen it, you'll see the dates of the plus certain numbers of days. So depending on which way you see it. Well, or not, this vertical put strategy, or I should say vertical swap strategy, which also goes by the name of calendar swap strategy, is something that in all the years that I've been trading, I have not seen anybody talk about. And something I just sort of came up with, believe it or not, about a year and a half ago myself. Just by experimenting with types of combinations of spreads, because all we're really doing here is taking a very simple vertical position with calls and doing a vertical call, a vertical spread, I should say, along with a vertical depth spread in a deferred month, and with puts or with calls. I'd not go into this, but you can imagine if you did the opposite. If you did your debit spread in the front month, and you do a credit spread in a deferred month, then you're looking at the opposite type of a position. It's a position with negative time decay that's from movement. And depending on the strikes you choose, you can have a directional trade with little volatility impact and little negative time decay, much better than just a straight bull call spread, because the bull call spread is going to have more negative time decay. The spread in the deferred month is going to give you a little bit of positive time decay to offset negative time decay on the front month. We're just combining these spreads so they have a hedge. You know, you sell an option and you buy one in the same month, that's insurance, and then when you do the exact opposite spread in a deferred month, that's insurance on the spread in the front month. So you can look at it from a whole variety of different angles, but the graph analysis on option view is what really allows you to see where your zones of profitability are and zones of vulnerability. Other question here: why do the spread swap? The spread swap and not just a straight out calendar. In other words, sell the front month and buy the back month. Good question. If we were to do that, we front month, the back month, just a straight calendar spread. The spread's decent. It makes good positive time decay. Notice the Vega factor. The Vega factor is going to be sometimes 10 times as large as the Vega factor. In other words, you are vulnerable to the unpredictable swings of implied volatility. And that's the part that we're trying to eliminate by doing the swap strategy. We want to make the beta factor as small as possible. We want to make the gamma as small as possible. And where the swap strategy really comes into play. We want to have positive time decay working in our favor with a very modest directional bias, or neutral if you want to do both the vertical put and the vertical call swaps together. We want to eliminate the sensitive vega, and that's really the real key to this strategy. The max loss potential on the swap strategy determined simply by the graphic analysis. You can take a look at expiration and see what the max loss is, but of course you would never want to hold it till expiration, as I mentioned before. But no matter what happens, you do have limited risk on these strategies. There's absolute limited risk on them. I would encourage any of you to feel free to go to the link that Jim put up previously on Facebook, so you can listen to this recording again and pick up whatever pieces that you may have missed the first time. And I appreciate all of you guys listening, and I'm doing webinars in the future as well. Thank you very much. Hope to see some of you in Las Vegas this week. I don't know what happened here. Wait a minute.